Hi, and welcome to Eye of the Needle, a podcast from Columbia Threadneedle Investments that aims to demystify the world of investing and shine a light on the people that look after your money. I'm Jim Griffin, investment writer, and joining me as co-host is Corinne Walker, investment campaigns manager. Hi Corinne, how are you?
I'm very well, thanks. Hello Jim. The sun is shining, summer is upon us, and we've got some exciting guests lined up on the show today.
I'm very glad to hear it. And who may those guests be?
In this episode, we're joined by two of our UK equity fund managers, James Thorne and Phil Macartney, who co-manage the Threadneedle UK Mid 250 fund. We'll be talking to them about the mid-cap asset class, what's currently influencing UK markets, and what it's like managing through the noise of Brexit. James, Phil, welcome to the podcast.
Hi guys. Hello.
Very nice to have you on. This episode will also feature our ongoing ABC of Investing series, the 60-second challenge, this month in history, and 3 things to ask your IFA this month.
But before we get to any of that, let's kick off with a few questions for James and Phil and get to know the faces behind the funds. So Phil, if we start with you, what made you want to become a fund manager?
Well, I'm pretty sure I never set out really to be one when I think about it. In fact, I never really, when I look back at sort of how I've ended up in sort of finance was not something when I was at sort of university or at school that I sort of thought about. So, what actually happened was I went to a presentation about investing quite late on in my sort of university career. And since then I got hooked on it. And, my background was in engineering and I sort of was trained as an engineer and everything like that. And engineering is about problem solving and trying to solve issues sort of, that sort of fix real world issues. And stocks and shares and investing is actually quite a good sort of place to sort of solve problems. That's sort of how I approach it. I look at sort of, stocks and shares as problems to solve and sort of trying to work out, what should these things sort of be valued at. And in that regard, that sort of logical expertise sort of lends itself quite well to it. So in a way, that's sort of how I've fallen into sort of finance and stocks and shares. And I love it. Yeah. It's the greatest job for sort of that outlet of sort of intellectual problem solving that I think I can find. So yeah.
So that's quite transferable skills there then.
Yeah, I think so. Yeah.
And do you use your engineering expertise in your stock research?
So, one of the first sort of sectors that I covered way back sort of, 12 years ago when I sort of started this industry was, engineering companies. Because again, I was a bit more familiar with those business models. I've sort of done a bit of sort of work through university with those companies, and it's lent itself to it. So I probably have a little bit of a bias, I guess, towards sort of looking at those because of my sort of engineering background. I like sort of looking at widgets and machines and things like that. But I think actually, that was also quite a good test bed and a good grounding, sort of how these things, how do these businesses operate, how do they make money, and actually a lot of the stuff that you see in that you can transfer into other industries and it all feeds into it. So it's been a fascinating journey, I guess, from that perspective.
Yeah. What about you, James? Was yours similarly sort of unintended?
I blame my mum and financial illiteracy for the 2 reasons of getting into fund management. I was studying oceanography and wanted to go into the oil and gas industry. And the reason why it's my mum's fault is she had opened an Alliance and Leicester Building Society account when I was wee. And when I was at university, I suddenly inherited these shares. And I had no idea about the world of finance, and I certainly didn't know what an equity was or what these shares were.
Yeah.
But very keen to maximise the beer money of these shares at university. I started to look into the financial pages and a little bit about equities and trying to understand what they were about. And I found it fascinating, and that really changed, I guess, my whole sort of, direction in terms of career, what I wanted to do. And I guess I was very fortunate at that time that, somebody in Bournemouth at Abbey Life decided to take a chance on somebody who had no formal training in finance. So that's how I ended up purely by chance.
It's 2 quite unusual routes then.
Yeah.
Very good.
Now, obviously, you both work very closely together, co-managing the fund. What does a typical day at work look like for you both?
Well, again, this is why I think this job is so great, because no day is the same. So I think using the word typical is, it's maybe not the right way, but there's definitely some structure to those sort of the way it operates. So, a typical day, we're up reasonably early. So I'm sort of, commuting into London, given the time that takes, it's actually quite a good time to sort of review some sort of the news that comes out at 7:00. So a lot of the news in the UK market is released at 7.
Yeah.
So it's quite a good time actually to be reading the news on your commute on the way in. So that's sort of what I do to try and sort of get up to speed with what's going on. And I'm usually in the office at around about 7:15, 7:30. So that's sort of when I arrive, to sort of like continue some more sort of formal proceedings with my day. And then really what I'm focusing on is sort of the results. And again, one of the skills in this job that I think is quite important is sort of trying to focus on what the most important stuff is quite quickly and trying to zone in on that. So, there could be days when there's loads of news flow, but actually you're just trying to focus on what's the most important bits to sort of try and what's changed, what's changing, and does that change your view? So that's sort of what we're trying to work out in the sort of morning hours.
Cut through the noise.
Trying to cut through the noise all the time, and to try and focus on what's the most important bit. And then I guess the rest of my day is basically taken up with meetings with companies, with analysts, with fellow members of the team, about debate, trying to test your thesis, trying to find new things, trying to meet companies that are doing they're on their life and blood on what's going on the ground, and really trying to understand what impacts that might have on the value of their business. So, and that's sort of how the day sort of runs, and a lot of it is it's grafting, it's hard work. We're sort of like we're sitting, we're spending a lot of time sort of working through numbers and documents and things like that.
How do you bounce off each other?
Yeah, we do. We bounce off each other quite a bit, I would have thought.
Yeah, I'm trying not to say too much because Phil normally blames me for talking too much. But I agree with Phil. I think the days are always very varied, and although we both come from technical backgrounds, and obviously there is a lot of technical work, there's an awful lot of it involves people, and especially at the smaller end of the market. So we meet a lot of people from different businesses. And they are very different. The businesses are very different, and that's really where the interest, really stems. Every day is very, very, very varied. And we try and get out of the office as well. So we go and visit businesses and meet the people who are actually on the ground running those companies.
Yeah. Okay. Now, talking of people, how often do you sort of think about the end investor and the ultimate client, if you like, when you work, and how do you put the client at the heart of what you do?
I think the first point is that our own money is in the fund, and I always imagine it that this is my mum again. It makes that this is my mum's money, and if would I be doing this with her pension? And I think it is important to connect back, and I think a lot of clients often ask us, do you invest in your funds? And I think it's really important to be invested in what you're doing, and so I think that's the main way.
So my mum's money actually is in the fund, so I really do have to concentrate on a day-to-day basis as well.
That's why you speak to her every day.
It is, yeah. She lets me know about it. So no, I think it's very important that we realise that this is a very this job comes with a huge deal of responsibility, and it's not just about capital growth; it's about capital preservation. These are people's savings. This is what they This is their life's work can be in our fund. So it's very important. That's how we treat it, and it is treated with that respect. So I'm reminded with all my sort of friends and family that do own the fund how it's doing. But it's very important that we're aligned with that with benefit, as James says. We have our own money in it. So yeah, absolutely.
Okay, so should we move on to a few rapid fire questions? Okay, Phil, what's your favourite book?
Okay, well,
This is supposed to be rapid.
Yeah, it's maybe rapid. I don't know. I read quite a bit, so I wouldn't say I've got a favourite book. So I'd say I'm going to use one which I think I read once a year, which is I read the Little Book of Behavioural Investing every year by James Monte, because it helps remind me of sort of how people think. So I think it's quite good.
Yeah.
Secondly, I'm going to cite one that I've just read, which is called Edge by Ben Littleton, and I'll sort of give a good plug to it. It's about basically football managers and successful managers and how they built successful teams. I think that helps me with sort of when I'm sort of speaking to CEOs and things like that. So a real plug for that book. It's an excellent book if anybody wants to know about it.
You're not thinking about a career change though?
No. Well, come on to my favourite sports team. You might see that. It might be that. And then third, I guess I just one of my favourite fiction books is actually The Girl with the Dragon Tattoo, which completely blew my mind when I read that the first time. So
fabulous.
James? Yeah.
Oh right. Okay. Yeah. I mean, I don't read a huge amount outside of The Economist and other New Scientist and material like that, which all relates to the job. But I'd say Unique Mind by Kay Jamieson, which is about bipolarism. Because sort of friends who've had some issues with that, and I think it's relevant in that we're Mental Health Week, and I think some of those people who have bipolarism have some of the greatest minds and have created some of the greatest things that humanity and society has. And I think there is and hopefully a greater profile about how much we have to care for all members of society and those that have mental health issues, which have been swept under the carpet. So,
Couldn't agree more. Okay, what about favourite film?
My favourite film is The Dark Knight, which is also directed by Christopher Nolan. I could literally watch that on repeat. It's for me. I just think it's such a good movie with such good acting in it and such good script writing. That it's brilliant.
I do like a bit of Nolan. It's good.
I'd go a bit more old school. Monty Python: The Life of Brian.
Classic.
It's the only film that I couldn't actually. I had to leave the room because I couldn't stop laughing for the first hour, and it still makes me laugh that much when I watch it. So.
Good stuff.
What about music? You got a favourite album?
My favourite album is one by The Strokes called "Is This It?" So that was one of my original albums from when I was sort of growing up, and again, it's timeless.
It is.
So,
I agree.
Okay, that's it.
But it's not timeless at all, really. I suppose Primal Scream, Screamadelica. I guess it's all about a moment of time in your upbringing that had a real relevance to that sort of defining moment as you were growing up. So
we want to be free to do what we want to do.
Exactly.
It's a cracker. And to sports team then, Phil. You alluded to it
so
earlier.
Sports is one of my passions. So I've got quite a few favourite sports teams, but I'll name two. First one's more difficult than the second one. Manchester United is my football team of choice. It's been pretty tough at the minute.
Agreed.
Even we managed to get a point off Huddersfield, so I'd say it's not a bad result.
Yeah, as a Huddersfield fan, it was a wonderful day for me.
So we'll see what the summer brings with Man United.
Yeah.
But, it's interesting. And then I'm quite a keen rugby fan as well. So my rugby team is actually my home team, which is Ulster Rugby. So a bit of a plug for that. But, which again, it's not always the greatest adventure, but it's the sort of it's the hope that kills you. Yeah. That's what we think.
Absolutely. Yeah.
Yeah. I mean, as Phil knows, I know not a huge amount about sport, but I still do like going to sporting events. And I guess I did used to go to the Dell, the Saints home when I was studying in Southampton. So and also I like a bit of an underdog, and certainly at that time they were I think it was 5 times that they survived not being relegated because Matt Letizier's genius. So
yeah, he was a genius, wasn't he? Very good.
And finally, you're on a desert island. You can take one food with you. What's it going to be?
So my real weak spot is actually burgers and chips, and the best burger and chips in London is Honest Burger. So I would take those. The rosemary chips is a die for.
Very nice. James?
And I would take Hotel Chocolat's 100% dark chocolate from St. Lucia. We're investors in the business. I've always loved chocolate, it's very good for you.
Excellent. Can't argue with that. Well, thank you very much, chaps. We'll be coming back to you later for more questions about the UK equity market.
We will indeed. Now, before we get you to both take our 60-second challenge, we're going to continue our exploration of the ABC of investing.
That's right. Regular listeners will know that each episode we take 3 letters of the alphabet and attempt to demystify the jargon-heavy world of investment, which, to be fair to the uninitiated, can appear impenetrable. Today we reach G, H and I, having so far covered, deep breath, active funds, bonds, the consumer price index, diversification, equities and funds in general. We won't be doing that roundup when we reach the end of the alphabet, that's for sure.
No, we won't. Anyway, without further ado, let's launch into this week's letters. G is for gilts. These are a type of bond issued by the UK government to raise money. With other bonds, there's no guarantee the original sum will be repaid, but because the risk of government defaulting is so small, gilts are considered the least risky type of bond.
H is for Hayek, Friedrich Hayek. This Austrian economist won the Nobel Prize for his work on the economic cycle theory, which has 4 stages: expansion, peak, contraction and trough. During expansion, the economy experiences relatively rapid growth and interest rates tend to be low. This leads to overexpansion, which necessitates a rise in rates to counter excess demand, and the economy begins to contract, and on it goes.
I is for income drawdown. Normally at retirement, you can take up to 25% of your pension pot as a tax-free lump sum. With income drawdown, the remainder is reinvested and you take an income from it as you choose. As your money stays invested, it can continue to increase in value, though of course there is the risk that it could also fall. So now we're going to move on to test James and Phil's economy of language with our 60-second challenge. This is a first for us, having two managers on to talk at the same time, so we're going to get some insight into your collaborative abilities.
The look they've just given you.
So, James and Phil, you've got 1 minute to try and describe the area you invest in for our listeners, which of course is UK mid-cap. Are you ready?
Well, we're probably as ready as we're ever going to be.
Yes.
So.
Go.
Okay, good luck. Your time starts now.
So, where we invest in the mid 250 index in the UK, which is the medium companies index. These tend to be companies that have already got a formulated business model and are looking for areas of expansion. So, the sort of dynamics that we see in this index are companies that have, capital to spend on potential new projects in innovation, potentially expanding into white space, potentially looking at sort of acquisitions to expand their addressable market. They tend to be companies that are driven by earnings growth rather than re-rating over time. So that's what we're looking for. And they tend to be businesses that have brands that are beginning to disrupt rather than be disrupted. You might see in large companies.
How long have you left me? To Phil's point, to expand on that, it's all about operational gearing and compounding. Mid-cap companies are brilliant because they've got over the issues of being a small-cap company where there are huge risks, but they're small enough and nimble enough to take advantages of lots of opportunities in the market.
Almost.
I spoke for too long. Yeah, sorry. That's unlike me.
I think we got a good flavour of it there.
Brilliant.
Excellent.
That was quick. 60 seconds, wow.
I know it goes faster than you think it's going
It
to.
does indeed. And James, you were supposed to be the verbose one there, eh?
Yeah, maybe Phil talks more than he thinks.
Okay, well, now it's time to take a step into the financial past to see what was happening in May throughout history. On the 6th of May 1901, E.H. Harriman was trying to amass a controlling stake of Northern Pacific Railway stock. Fellow rail tycoon J.P. Morgan, a name most people will be familiar with, got wind of this and started buying shares to prevent Harriman's bid. This led to the most exciting scenes traders ever witnessed, according to a Chicago newspaper, with shares climbing from $115 to $1,000 within days.
On 10th of May 1965, a young Warren Buffett assumed control of a failing textiles business called Berkshire Hathaway. Shares were $15 at the time. The rest of Buffett's career is of course well known, while shares in Berkshire Hathaway now trade at around $300,000.
And on the 20th of May 1999, startup internet retailer eToys Inc. went public. Shares were issued at $20 and at the close of the first day had risen to $76. 19 months later, however, the company went bankrupt with debts of $247 million. So, Phil and James, eToys there were a classic emblem of the dot-com bubble. At the risk of offending either of you on the grounds of age, do you have any memories of that period? Were you working in finance then?
Yes, I was. I guess I had just moved from Bournemouth, where I got my first job at Abbey Life, to work in London with Ashton Bradbury at Hill Samuel.
Right.
I was a bit of a legend of the small cap market, and I was given the opportunity to look at technology. And I decided to move to small cap, one, because I think he inspired me that, small cap wasn't a dull area. The small cap universe had been pretty lackluster for about 6 years, exactly sort of the period after the two professors at the London School of Economics had put forward an academic paper showing the benefits of small company investment.
Right.
So I was taking a bit of a risk, I guess, because a lot of people were saying, well, it's a dull and boring sector and it's never going to come to anything. And that was just about the time when everything suddenly changed and the dot-com bubble took off. And it was very difficult because obviously I had no experience of investment. It's interesting because a lot of people are starting to draw parallels to it, but I don't think we've seen what a bubble is really like at the moment. I mean, this was a case of you met a company on the Monday Monday morning. You started to go to meetings where the room was crowded full of hundreds of people, and half the people would start to leave halfway through the meeting to go and put trades on to buy the stock.
Wow.
And you would have shares that on a Monday morning were worth £10 being worth £50 by the Friday afternoon.
Okay.
And it seemed everybody and their dog were buying and trading technology shares. And in that period, I stayed at Hill Summer for a while. The business was actually bought by Scottish Widows. It was going to move to Scotland, and I moved to 3i, the venture capital firm, and was also involved in some of their technology investment. And it continued for a lot longer than I'd expected. And the correction was very aggressive and very painful. And I learned a lot through that experience. Yes, I mean, it'd be interesting to see. There are some danger signs that we could see a transfer of the bubble that I think does exist in private equity and technology investing in the US being transferred to the quoted market. Now, hopefully it won't end up in the same scenario we had in 99.
I mean, it must be great experience to manage through a dip as well as a steady rise.
Yes, I mean, it's certainly a different psychological feeling. And I think, I guess getting over your normal human psychological reaction comes from experience. And so I'm very much, going to use that experience to make sure to counter, as people are termed, exuberance that investors get during bubble situations.
I wasn't really around in 99. I was still I was like 14 years old back then. So, but I think what I think I would comment on is like, when I was that age, we had the internet was in our house. And it was still the dial-up. Dial-up when it was made that funny noise, and everything took ages, right? And I would just think, 20 years on, it's only 2 decades. It's more than sort of half the years that I've been on this planet. Yeah. What we've moved to, where I can sort of, I can make a transaction on my phone that is delivered the same day to my door. At the click of a finger, it's my fingerprint doing it now, and I think that acceleration in technology and the leap, I guess, that we've seen in those 2 decades, I think, versus what we've seen previous to that in when you look back in history, is amazing, really. Yeah. So and it's opened up a whole new area for people to look to invest and to exploit. The way that we interact with the consumer today is so much different than back then, and I think. I wasn't around in the stock market at that point. I saw the financial crisis rather than the sort of technology crisis. Yeah. But I just think about the innovation that we've had. It's amazing.
Agreed. Right. Well, I think it's time for another round of questions. We'll find out how Phil and James approach the world of investing.
So James, the UK market's had a pretty rough time in recent years, dominated by Brexit. Has this made your job harder?
I think it's created opportunities, so I don't think it's necessarily made it harder. It's increased the volatility in the UK market. Obviously we've seen lower asset flows into the UK equity class, and as a result of that, and I think also a lot of nervousness about the domestic economy, that has, as I said, created opportunities. I mean, I think when the referendum vote happened in 2016, all the commentators were saying that they expected the UK to go into recession within 2 or 3 months. And I think at that time what we did and what we continue to do is we went back to fundamental research. So the week after the referendum vote, we went out and spoke to as many companies as possible about what they were seeing and to keep us very close as to what they were seeing in the marketplace. And it came very clear to us within, 2 or 3 weeks that our view was that wasn't going to be a recession. And that created quite a lot of opportunity. But I don't think we don't necessarily change our investment process or philosophy because of the macro environment. Obviously, quite often we're looking to overlay that. But we're looking for good quality businesses where we can see the opportunities are really there, whether or not the sun is shining economically or whether it's pretty grey.
Yeah, I think Brexit introduced an element of risk across all UK assets, whether they were domestic or whether they were international, and it sort of gave us such a broad brush to that has given us real opportunities to buy, as James says, good quality compounding business models at attractive prices, which sort of is our job. So I think it is hard to sort of see. We're not here to forecast the outcome of Brexit, and I think anybody that says they know the outcome of Brexit is you just can't possibly have a view because we haven't got a crystal ball or a time machine to go forward. So it's all about sort of risk-adjusted returns, and we test all our companies. What would happen in scenario X? What would happen in scenario Y? What would happen in scenario Z? And what's the outcome, and how would you react to that? And I think it's all about that scenario analysis and planning to help give us the confidence around which businesses we think we can back and which ones we think we should sort of stray away from. So yes, it's made it tougher. I guess it's introduced a new level of questioning, and there's a new topic to discuss with management teams. But ultimately, businesses see through this. So if you look at the history of certainly the mid 250 index, it's seen a lot of crises. Back to James's, the tech boom and bust, the financial crisis. This index has outperformed other global indices by quantums of 2-3 times in a total return, even despite those crises. And I think Brexit will be the same. I think it will see through this period, and we'll look back on it as a great opportunity to buy good businesses at reasonable prices.
And as small and mid-sized companies tend to be more domestically focused, has this affected you both more than, say, your more global-facing colleagues?
I think we've had to take into consideration, because it's been more important for us in terms of making sure that, we're in the right businesses, and it's had a bigger impact. Ultimately, no, in that, back to what Phil was saying, we're looking for good quality businesses, whether they be domestic or whether they be international, and we're really driven by valuation and the strength of their structural positioning in their marketplaces, rather than, we want a portfolio that's domestic or we want a portfolio that's international.
I might I'd pick out a couple. So one being Britvic, which is obviously owner of the Robinsons brand in the UK. They've chosen the last 4 years to invest heavily behind their supply chain, behind their manufacturing expertise, behind brand investment, really sort of taking a more positive view on sort of the disruption that they're seeing in the market to create a better brand, to create a strengthened position, and actually will emerge from this a stronger business. And that's the sort of businesses that we're sort of, we're looking forward to sort of back on that medium-term view. So again, companies that can sort of swim against a bit of the tide of sentiment. They're not just necessarily reading the paper every day and adjusting their strategy because of what the Times, the Telegraph say. That's what we're looking for, and what we think will pay off in the sort of long run in the portfolio.
So you've benefited from mergers and acquisitions in your portfolios over the year. Can you tell us a bit about how this benefits your fund and what M&A activity you see going forward?
Well, obviously, we don't invest purely for businesses to be taken over, but obviously there is a time and a place where other companies can really see a value, often where there have been changes in the market and trends, and they haven't been nimble or dynamic enough to get exposed to these trends, and therefore to buy a business to get that exposure makes a huge amount of sense for them. One area that we think is very interesting is what people are terming as sort of the fourth industrial revolution, which is all around data. And there are some leading data businesses in the UK market. So we're invested in several of these companies. Now, we're not saying that they're going to get taken over, but these are great businesses, and we really like these companies. And there is a good swathe of businesses all based in the UK that are taking advantage of that opportunity. Now, over time, as that market starts to mature, there are larger businesses globally that could really see huge value from buying those companies.
I think it's quite interesting at this point of sort of the economic cycle. You would tend to have expected private equity to become sort of more active in the market, and you're not really seeing that today. And I think again that's because of the cloud of Brexit, which again is giving, back to the opportunity point, investors opportunities to buy businesses at good prices before they're realised by a potential corporate buyer. So what we are seeing is the rise of activism, and we're seeing several businesses in the 250 get activist investors on the register and sort of look to enhance the value of the shares because of the depressed nature. Again, I go back to looking at the index level overall. You can still pay the same price for this index today as you could 23 years ago. I mean, that's pre the internet bubble. Going back to the previous point, when it was dial-up internet. So in that context, it's only rational to think that potentially international corporates might be looking at some of the high-quality niche businesses in the UK that are trading at substantial discounts to their international peers, and so I expect, as the cloud of Brexit is sort of released, might not go blue skies, but at least it might not be dark grey.
Yeah.
That some of that value will begin to get realised. So we've not got the time machine to sort of go forward and say it's A, B, or C that's going to get bought, but I'm quite quietly confident that the value will be realised.
Okay. And aside from Brexit, do you see any other risks on the horizon?
Well, I think what we're seeing in terms of trade talks with China and the US are going to go on and on for years. I think at the moment, it's reached a sort of a crescendo at the moment. I think we'll back off from that, but I don't think ultimately in the next decade that issue is going to go away. It's sort of the new Cold War, and it's really about intellectual property, and it's around the US wanting to defend its intellectual property and China wanting to accelerate that process. And I'd argue that China is partially buying into that by buying international companies, but also buying the technology kit to develop their IP and accelerate it. And I think the US, in terms of how that relationship develops, that is a risk for all of us globally, but also in terms of how productivity and wealth creation is going to develop for the world as a whole.
Listen, it's always little risks. There's just risk everywhere, right? In life, and part of our job as fund managers is to sort of we're macro aware, not macro driven. So I think that's one of the things I would say is that we're obviously aware of everything that's going on, but it's not going to necessarily drive our investment decisions as to sort of where we put our money because of what we think might happen in the macro. So we always go back to the fundamentals. What is this company's cash flows valued at relative to its share price today? And is that giving us enough margin of safety to buy the business at a reasonable price to allow us to, if those risks did surface, the share price should be relatively resilient through that. So again, that's what it's always coming back to is, we're constantly scanning for where the next sort of, mole raises its head and what that might be and sort of trying to think of the impact that might have on our businesses and in the long run. But what I would say is, we don't just, because China and the US, for instance, are having very difficult discussions, doesn't mean that we're not going to look at industrial companies. Back to what it is. There will be some industrial companies that the risk of that blowing up is over-exacerbated in the share price, and that can therefore give us a good opportunity to buy the shares.
Absolutely.
Okay, so finally, another question just back on your career. What would you consider your greatest success professionally, and is there anything you would change if you could go back in time? Should we start with you, James?
It has to be working with Phil. Sure. I think becoming a fund manager, I think it's a very privileged job to be able to look at these businesses and invest other people's money who put their trust in you. And so it carries a lot of responsibility, but it's also very enjoyable and very rewarding. And I think also, the charts and the decision I made to focus on small and mid-cap companies. And I get the opportunity to invest in businesses from, 40, 50 million market cap up to 4 or 5 billion. And so you really get to see and live through how companies develop and how they build and how the people who run those businesses develop and how industries can change over time, because a lot of that change happens in the small and mid-cap. So I think that would be, that would probably be, it's covered off my whole career, but
I'd sort of reiterate what James says. To get to this point has, it's a hard road to get to becoming sort of a fund manager and being responsible for other people's money and talking to companies at that level. I get to interrogate, CEOs on a daily basis. What more privileged job is that? So I see the whole thing as a sort of success. I wouldn't define one point or one action as the most successful issue within it. And I think I'm always cognizant that, success is sort of earned. So it's always about sort of trying to go over all the mistakes you make, which, we're human. The best fund managers in the world make 53% of their decisions correctly, but they put 80% of their money behind it. So, that's the camp you want to be in. Okay. So it's where you've made those mistakes, sort of trying to go over that ground and try and understand and build on it and learn from it so you don't make those mistakes again. And so, hopefully the great success is ahead. And that's sort of what we're aiming for. It's again, like James says, this job is so varied, it's so interesting, it's so intellectual. it gets you out of bed in the morning with sort of a spring in your step to sort of see what the day holds.
He didn't mention me though.
Is there anything you would change? Maybe pick a more exotic market?
No, listen. Again, I go back to why when you look at the history of the UK mid-cap space and the success that asset class has had, there's ample opportunity to make great returns picking interesting businesses in the UK. So, yeah, it's very easy and tempting to get withdrawn into some emerging market I stick to your knitting. What do we know? I feel like between James and I, we've got a good level of experience in the UK market. We know those business models well, and we can exploit those.
And it's not to suggest that the great thing is a great balance between very exciting and very interesting because they're small businesses, but also we're backed by the strength of a developed market legal system, very strong governance globally, and so there is a fair playing field. And so the good thing is that we can be systematic in our approach and all of those great things, and that is only getting better over time. Emerging markets are still the Wild West, not the Wild West, but
yeah, there's more inherent risk. So so I think on a risk-adjusted return base, I think it is still a great place to invest. And there's, like I say, it's changing every day. So there's always something new to look at, even in the UK, which people might perceive as one of the more boring markets, sort of globally.
Yeah. Great stuff. Well, thank you both very much. Now, before we finish, we're going to quickly look at 3 things you can ask your IFA this month.
With people generally living longer in retirement, it's never a bad time to revisit your occupational, private and state pension provision. You should receive an annual statement for your occupational and personal pensions and be able to project what your retirement income might be. A good IFA can advise you on how to work towards maximising this.
Now, not all your savings need to be long term. You might need quick access to cash while still maximising its earning potential. Talk to your IFA about your options, from current accounts which require minimum monthly funding to instant and easy access saving accounts that don't tie your money up for long periods.
And if you're approaching retirement, it might be time to revisit your life insurance situation. If you are financially stable and there would be no loss of income if you were to pass away, then the need for life insurance may no longer exist. Discuss your position with your IFA and you may be able to save yourself the monthly premiums.
And that's about it for this episode. All that's left is to thank our guests, James Thorne and Phil Macartney.
Thank you very much. Thanks for your time.
And also thanks to co-host Corinne Walker.
Thanks for having me.
And we will be back next time when we'll have another fund manager or managers to take on our 60-second challenge and talk us through their specialist field. If you have any questions or suggestions for the podcast, let us know at podcast@columbiathreadneedle.com. But until next time, thanks again for listening and goodbye. Important information. Your capital is at risk. Past performance is not a guide to future performance. The analysis included in this podcast has been produced by Columbia Threadneedle Investments for its own investment management activities. Information obtained from external sources is believed to be reliable, but its accuracy or completeness cannot be guaranteed. None of Columbia Threadneedle Investments, its directors, officers or employees make any representation, warranty, guarantee or other assurance that any of these forward-looking statements will prove to be accurate. The mention of any specific shares or bonds should not be taken as a recommendation to deal. This podcast is not investment, legal, tax or accounting advice. Investors should consult with their own professional advisors for any advice. Issued by Threadneedle Asset Management Limited, registered in England and Wales, number 573204, Cannon Place, 78 Cannon Street, London, EC4N 6AG, authorised and regulated in the UK by the Financial Conduct Authority. Columbia Threadneedle Investments is the global brand name of the Columbia and Threadneedle Group of companies.